All right, let's go ahead and get started. Today is, excuse me, Monday, October 9th, 2 p.m. section. This section is being recorded. First, I'm going to hand out the sign-in sheet. Again, make sure you sign the sign-in sheet for attendance for today. So primarily what we're going to do today is talk about homework 6 and 7, going over the ROIC tree and CFI analysis. We're also going to do kind of an in-class practice because, excuse me, 1 week from today, you'll be making your second 10-minute group case presentation on the historical analysis going through the ROIC tree and CFI. The company is going to be Tesla. Okay? So I previously told the earlier sections Amazon, but I've changed my mind. I'm going to do Tesla. So basically, you'll have to do their ROIC tree presentation, their CFI. Now, I'm not going to give you a full solution to homework 7 because based on the last two classes, they basically said most of them were able to successfully create the ROIC trees and create the CFIs. So since based on half of the students, they said that they didn't really have trouble doing that. No one copped to saying that they did. Then I'm just going to give you income statements and balance sheets for Tesla historical. You're going to have to convert them and create the ROIC tree and the CFI based on what you've done. So what I would suggest is take one of your group members who has a model that you're comfortable with, use that model for the basis for your group for that conversion, and then the basis of the presentation. Now, when you're doing the PowerPoint, I don't really need the Excel file. What I'm going to be looking at is the ROIC tree in your PowerPoint and the CFI in the PowerPoint, and that's what you're going to spend your 10 minutes analyzing. So that is 1 week from today, group case project number 2. Any questions about that? Again, company's Tesla. I'll be posting it shortly. The raw income statement balance sheet data to do the conversions. Okay, also coming up soon, on Wednesday, we are going to start the next section of the class, which is valuation. Okay, so we're going to start building reusable Excel valuation models, the enterprise DCFs. So that's the third section of the class. We'll start building those models starting on Wednesday of this week. So come prepared, ready to go with Excel to build the models, all right? And again, based on what I've heard, I was actually trying to make a choice because part of what you did for homework 7 is actually the basis for the valuation models, okay? Because if we take what you've done, which is take financial statements that you've converted, we can then forecast those statements, and then that will get us the enterprise DCF. So essentially, you've actually done a good chunk of what is necessary to start building out that valuation model in your last assignment. I was assuming that if people struggled with that, then I was going to actually give you a solution for homework 7 and let you build off of that model. But based on the last two classes, they kind of said they didn't have trouble doing it, so therefore we'll be building on the models that you previously have done. Yes?
So for the evaluation, are we still going to use Costco?
If I'm sorry?
Are we still going to use Costco?
Well, Costco's is kind of like your base template.
Okay.
Okay, so to do Tesla, you'll basically take that Costco template, put the income statement balance sheet data into the Costco model, and everything should be auto-converted and auto-analyzed if you did it correctly. Okay, so it shouldn't be that much difficult to do company number 2. It's kind of, again, the general idea of the reusable models. But your homework assignment this week was on Costco. Your group presentation in that format is going to be on Tesla. Okay. Other questions? All right. Also coming up, so that's next Monday, 1 week from today, October, was that 16th? And then Wednesday, October 18th is the midterm exam. Okay. So the midterm exam will be a 10-question multiple choice exam that covers the first half of the content of the semester. It's an open book, open note exam, but it can cover anything that was in the book, any of the readings in the book, anything we covered in class, any of the PowerPoints that were given out during class, but it's going to cover theory. Okay? And every multiple choice question will have none of the above as an answer. Okay? But nonetheless, it's going to test you on content and theory. Yes?
Helm says that there's only 2 questions for the exam. Is it gonna have?
I would not pay attention to Helms. I'm telling you, it will be 10 questions. It will be multiple choice. Okay? And it will be updated by me. I haven't updated it yet. All right? So, that exam you will take during the class time that you're registered for. So in this case, you're section 201, so you're taking it between 2 p.m. The exam will open at 2 p.m. and it will close at 3:30. Now you're going to take it online through Canvas, so I'm not going to watch you do the exam. I'm subject to the honor code. You can do the exam at home. You can do the exam wherever you want. It's just an individual exam that will be logged in to complete that exam. Again, it's open book, it's open notes, but again, no collaboration. Serious honor code violation because it's a midterm exam. Okay? So I've been asked by previous classes, like, how do I study for it? I don't really have a good answer because since it's open book, if you're familiar with the content, you can always go look it up in 10 questions. It shouldn't be that hard to do in 90 minutes. If you've never purchased the book, didn't read anything, haven't been paying attention, well, it'll be a different story. That's on you. Okay? But I at least review some of the key things we've done. Because an example question, excuse me, might be, which of the following would improve the operating ROIC of a company? A decrease in excess cash, an increase in operating liabilities, a decrease in interest-bearing debt, a increase in property, plant, and equipment, none of the above. Like, those are the questions that you're going to get. Okay? Again, kind of testing you, concepts, theory, that you actually understand what we have been talking about this semester. Okay? If you have an ADS accommodation, you have a, excuse me, that period of time to take the exam. Everybody else has to do it in 90 minutes, and otherwise would have to do it during the section you're registered for. So again, in your case, 2 to 3:30. Okay? Questions about the midterm? Also next Wednesday, the first half of the Bloomberg Trading Challenge comes to an end. Basically, at the end of the day, Wednesday, October 18th, I will just take the overall performance of your teams from best to least and then start assigning the 5 points of the grade. Team in first place gets 5 points, second and third place gets 4 points, and then 3, 2, 1 after that. Okay? Now, very important, you can't have more than $300,000 worth of cash. Okay, so anything $300,000 more, you'll be disqualified. So don't liquidate your portfolios. Keep them invested even through next Wednesday, and make sure you're meeting that requirement all through that. You also have to have at least 10 longs. Shorts don't matter, don't count towards your grade. You have to have at least 10 longs. So minimum 10 longs, no more than $300,000 worth of cash, and then it's based on the relative performance by dollar amount, whether you're making or losing money, on how the 6 teams in your section do. Okay, that'll be the Bloomberg Trading Challenge first half. Then Thursday, October 19th, I'll reset everybody back to $1 million, and then you'll do another 6-week sprint. Same set of rules. Okay, so that is coming to an end next Wednesday, first half Bloomberg Trading Challenge. So next Wednesday, you have your midterm exam. Next Wednesday, you have the Bloomberg Trading Challenge ending. Next Monday, you have your second group presentation. Okay? And this Wednesday, we're going to start building the reusable valuation model. Now, I'm not going to make a homework assignment due next Monday because you got a lot to do next week. Okay? So your next homework assignment will be due 2 weeks from today. Will be the next homework 8. Okay? But just FYI, that's what's kind of coming up. Lots coming up here in the next couple weeks. All right, again, any questions about any of that? All right, so again, what I want to spend our time on today is going over the last 2 homework assignments and doing a little bit more practice in advance of your next preparation. So your first homework assignment that I want to cover was on Walmart. That was homework 5. And you had to walk through the ROIC tree of Walmart. Homework 6. All right, so this was the ROIC tree, this was the CFI. this was also a big clue. So when you were building homework 7, like I gave you kind of a format for the CFI, and I gave you a formatted ROIC tree, which you could have used that formatted ROIC tree, so you don't have to build one yourself in homework 7. Specifically gave you this file in Excel for that reason if you had to kind of figure that one out. But that being said, you still had to analyze I'll start out with the tree. Now, when you did the tree, what's also important is that we're no longer just talking about the beginning and the end. We have to talk about the numbers in the middle, okay? So the trends in the middle are important. You have to use numbers, and you have to connect the dots, right? So let me tell you what's going to get a really bad grade, particularly on your presentation next week. So if you get up here and you say, Walmart's ROIC in 2018 was 10%. Walmart's ROIC in 2022 was 9.3%. Walmart's tax rate was 37%. Walmart's 22 tax rate was 33.6%. Walmart's pre-tax ROIC is 16%. Walmart's pre-tax ROIC in 2022 fell to 14.1%. Okay, so if you just give me those numbers, I know you're not blind. All right? I know that you know how to read numbers. That's irrelevant towards your grade. All right? What matters is the context. Like Walmart's ROIC fell from 16 to 14.1. It fell for these reasons. When the margin changes, it impacted the ROIC positive or negatively. Like you have to connect dots as you go through this tree, as I'm about to show you as we go through the solution. You also have to use numbers. You can't just say Walmart's pre-tax ROIC went 16% and went down 12%. Okay? So it went from 16 to 14.1. That is a 12% decline. You have to use numbers. If you don't use numbers and you just read numbers, you're going to get a really, really bad grade next week. All right, so I'm going to give you an example of what I consider to be a better presentation, and it's important that you do it in 10 minutes, so approximately 5 minutes for the ROIC tree, approximately 5 minutes for the CFI, and you got to get through all of that through Tesla in that 10-minute period of time. So I can get up here, look at the tree for the first time, riff, and probably handle this. I wouldn't recommend it for you because you're going to have a lot of data to get through in a short period of time. So please practice in advance of next week. All right. So I'm going to set my iPhone to 5 minutes, and I'm going to see as a countdown timer, and I'm going to see if I can get through this ROIC tree in 5 minutes. Okay. Thank you, sir. Anybody else need this sign-in sheet? All right. Here, and let's practice on Walmart. In 2018, Walmart's after-tax ROIC was 10%. By 2022, it had fallen to 9.3%. That was a 6.9% 5-year decline. Okay. Now, Walmart's ROIC didn't just drop over the 5 years. It actually improved, and by 2021, it had gone up to 13.6%, and then it fell from 13.6% to 9.3% between 2021 and 2022. Looking at the next level drivers, first we'll start with the tax rate. In 2018, Walmart's tax rate was 37.4%. By 2022, it had fallen to 33.6%, a 10% decline. That was one of the reasons why Walmart's after-tax ROIC should be improving, right? Now, obviously, their pre-tax after-tax ROIC went down, so the tax rate wasn't the reason for that, right? And by the way, Walmart actually paid an even lower tax rate in 2021 of 25.4% before increasing to 33.6% in 2022, okay? Now, looking at the pre-tax ROIC, which was responsible for the entire drop of the after-tax ROIC, in 2018, their pre-tax ROIC was 16%. 5 years later, it fell to 14.1%, a 12.1% decline. Again, between 2018 and 2021, it actually rose to 18.3, and then between 21 and 22, it fell from 18.3 to 14.1, right? But it was that drop in pre-tax ROIC which explained the drop in the after-tax ROIC. Looking at the next two drivers, what happened to its operating margin? In 2018, Walmart's operating margin was 4.3 cents. By 2022, it had fallen to 3.3 cents. That was a 1 percentage point drop in operating margin. And that was one of the big reasons why the pre-tax ROIC fell. Okay. Now, interestingly, again, it had actually gone up between 18 and 21 to 4.5 cents, and then fell from 4.5 cents to 3.3 cents, mostly between 21 and 22. Okay. Invested capital sales went from 26.7 cents per dollar to 23.8 cents per dollar. That showed an improvement in productivity. Okay. They did 11% less invested capital per dollar of sales. Now, all of that improvement didn't come between 21 and 22. Actually, between 2018 and 2021, the invested capital sales actually got better from 26.7 to 24.8, and then even better in 22 to 23.8. So thinking about the second and third level drivers, why did the pre-tax ROIC go from 16 to 14? It was primarily because the operating margin went down by 1%. Okay. Looking at the second level drivers, why did the operating margin fall? We'll start out with gross margin. In 2018, Walmart's gross margin was 27.2%. By 2022, it had fallen to 25.9%. That was a 1.3 percentage point decline in gross margin over that 5-year period of time. Okay. Now, again, most of that drop, 1.2 cents of that, came between 21 and 22. So, like the other operating margins, the gross margin improved between 2018 and 2021 before falling in 2022. SG&A over the 5 years was pretty flat. It was 20.8 cents per dollar in 2018. It remained 20.8 cents per dollar in 2024, though in 2021, it went from 20.8 to 20.6 and then slightly up to 20.8, but relatively flat over the 5 years. Right? Depreciation went from 2.1 cents per dollar in 2018 to 1.8 cents per dollar in 2022. And again, relatively flat, but a 0.003, so they had about 0.002, 20 basis point improvement in depreciation per dollar of sales. So really, when we think about what was driving the operating margin lower, it was the gross margin. That was the primary reason, that drop of 1.3 percentage points in gross margin from 27.2 to 25.9 is the primary reason operating margin went from 4 to 3. If we look at the improvement in productivity, invested capital to sales, working capital stayed at about negative 1 cent over the 5 years. It was pretty flat over that 5-year period of time. It was 1 cent negative in 2018, 1 cent negative by 2022. Really, the improvement came in their PP&E to sales. In 2018, Walmart was spending 21.7 cents per dollar on PP&E. By 2022, that had fallen to 19.5% per dollar. That was one of the reasons why invested capital sales went down. There's a big improvement there in invested capital sales. Again, that was pretty much a straight line improvement from 2019 through 2022. Tangible to sales went from 6.1 cents per dollar in 2018 to 5.3 cents per dollar in 2022. That was, again, about a 0.08 cent improvement in invested capital to sales. But when you think about it, I'm at 5 minutes, so I have to be more efficient next time. But when you think about it, the PP&E to sales and the slight improvement in intangible sales were the primary reason invested capital sales improved, which was offset by the 1 point drop in operating margin over the 5 years. And that drop in margin, despite the productivity improvements, is why the pre-tax ROIC went from 16 to 14, and despite a slightly lowering of the tax rate, why the after-tax ROIC went from 10 to 9.3. 5 minutes, 35 seconds. What I was missing in there, context. Why did their operating margin fall 1% over 5 years? Like, if you were just listening to that presentation, that's probably the question that would be on your mind if you're a financial person. Like, that's the big deal. The reason their ROIC went down is their operating margin fell 1%. Why? What caused this? And by the way, most of it seemed to happen between 21 and 22, where their operating margin fell from 4.5 to 3.3. Anybody have any idea why that went down? Did we look that up? Because that would be the one additional fact that I would expect you to tell me in your presentation. Because it's just so obvious that that's really important. What do you think happened to Walmart between 21 and 22? It was the pandemic. And during the pandemic, they tried to keep their prices low. And prices were low, well, inflation was starting to surge and supply chain issues were out there. So the cost went up and their price stayed the same. Put pressure on their gross margins, right? And that hurt their overall ROIC over time, okay? And so I'm just saying, a little bit of context, take 10 more seconds, say that, and then you got a 5 out of 5 going towards a 10 out of 10 for your presentation. Okay? But I told you, even me, that was 5 minutes and 35 seconds or so. And plus, I got to say something about the pandemic. Now we're at 5:45. I got to be tight on my time because I'm now taking away from the CFI people who now have 4 minutes and 15 seconds left to get through the entire CFI. So your first time presenting this should not be next Monday. You should be practicing with your teammates, getting feedback to make sure that you're using numbers, connecting dots, talking back through how it affects other parts of the tree. And if you're going to share real world context, you got 7 or 8 members on your team, somebody look up Walmart. Okay? In your case, somebody look up Tesla. What's going on with the changes? Questions about the ROIC tree for Walmart? All right, let's do the same thing with their CFI. Resetting my timer for 5 minutes. Over the last 5 years, Walmart generated $58.971 billion worth of operating free cash flow. That was generated because they generated $131.6 billion of gross cash flow for the income statement, and they reinvested $58.4 billion of investment back into the balance sheet. That represented a 44% average reinvestment rate over the 5 years. Walmart then spent about $14.2 billion on acquisition premiums, almost all of that occurring in 2018 when they spent $12.9 billion on improving additions to goodwill, and that led to an overall $58.97 billion of operating free cash flow. Over the 5 years, Walmart did average 108% capex to depreciation ratio, which suggested they weren't trying to grow that much over the 5 years. However, Walmart's capex depreciation ratio in 2022 was 160%, suggesting that they do expect some growth in 2023, and their capex depreciation was 54% in 2020, suggesting problems with the pandemic, recognizing there wasn't going to be a lot of growth and a lot of spending during the pandemic. All right. Now, how did $58.97 billion of free cash flow turn into $48.4 billion of CFI? Clearly, they spent almost $10 billion on non-operating items. So over the 5 years, they had a non-operating loss of $9.9 billion, most of it occurring in 2018 when they lost $5.5 billion, and 2021 when they lost $4.3 billion. Maybe I'll give you a reason for that. I also saw that Walmart had an increase in their non-operating assets of about $1.7 billion, most of that occurring in 2019 when their non-operating assets went up by almost $4.6 billion. Those non-operating losses and investments resulted in a CFI available to pay to shareholders of $48.4 billion. How did they distribute that $48.4 billion? Walmart paid $6.7 billion of after-tax interest expense over the 5 years. In 2018, it was about $1.2 billion. 2022 was about $1.2 billion. The interest expense payments were pretty flat over the 5 years. Okay. They also increased their debt by $16.5 billion, most of it occurring in 2018 and 2019 when they borrowed $11.7 billion and $18.2 billion respectively. Okay. Now, Walmart also distributed $904 million of minority interest dividend payments over the 5 years, and they did increase the minority stakes in their balance sheet by $4.3 billion, most of it occurring in 2018 when the minority interest shot up by $4.2 billion. They paid out $30.5 billion of dividends over the 5 years, again, approximately $6.1 billion a year of dividends each year over the 5 years. So really, the big other investment was $35.5 billion of share repurchase over the 5 years. In 2018, they bought back $7.4 billion, then $5.7 billion, then only $2.6 billion in 2020 going into COVID. Then they bought back $9.8 billion and $9.9 billion. The share repurchase and dividends represented about $61 billion of payout to the shareholders. They only had about $49 billion of CFI. That was the primary reason Walmart issued that $16.5 billion worth of new debt. I got 57 seconds left. So the CFI may go a little faster than your ROIC tree, but nonetheless, 10 minutes for both. Questions? All right, so that was Walmart. Now let's talk about Costco. So homework 7, you started out with an income statement and balance sheet and change in equity, and you had to do your TFI, TII, CFI. Was everybody able to do and get a TFI and TII to balance? Anybody have trouble with that? You want to ask me about something? Talk about something? What about your CFI? Did you get your CFI to balance? Okay. One of the challenges of this exercise was because I didn't give you labels, you had to figure out what was operating and non-operating, right? But then again, a previous homework assignment should have given you clues outside the book, right? The general idea of an operating asset, once again, is that when revenue changes, when sales change, then the operating investment changes, okay? So that's the idea, it's recurring, right? Sell more stuff, need more investment, okay? When sales change and the investment doesn't change, has nothing to do with sales, that's the whole idea of a non-operating investment. It has nothing to do with running the business day to day. That's the whole point of excess cash. Like having excess cash in the bank has nothing to do with the future sales that Costco or Walmart are gonna have as a business. So that would be non-operating, okay? If Walmart sells more stuff, they're gonna need more inventory. If they sell more stuff, they probably are gonna open more stores. That's why it's operating, okay? And that's really the difference between the two. Now, in homework 5, you had to create an operating invested capital custom formula in Bloomberg. That also gave you hints as to what was gonna be operating, because you had to do excess cash, revenue times 2%, or sorry, operating cash. You had to do an operating working capital, right? And I gave you the items that generally went into operating working capital, including other current assets and other current liabilities. And so if we built out what was operating invested capital in Bloomberg, you should have used that as a clue as to what would be operating for most of the companies that we would be analyzing, okay? And so in that case, that would have helped you got to your operating invested capital, right? Anything else would be non-operating, okay? So again, excess cash being one of those. Now, I heard in one of the sections that somebody went to the TAs last week and the TAs suggested a shortcut, which they used, which would have been okay, which was figure out what's non-operating and everything else must be operating. So basically subtract, okay? But I don't like black boxes, right? I don't like plugs that give me answers. I kind of want to know what's behind the plug. So I prefer the build-up method of this is my working capital, this is my PP&E, this is my goodwill, add them all up for operating invested capital. But if you'd use the plug method and you figured out non-operating items and subtracting at operating items, it's perfectly okay for this assignment. But I will tell you, starting Wednesday, when we start forecasting companies, we're going to forecast working capital and we're going to forecast PP&E differently. So we don't want them bundled and just having one blob of operating invested capital, because they're not going to grow at the same rate. Just like the non-operating assets and liabilities aren't going to grow at the same rate. So we want to be able to forecast them differently, right? But nonetheless, for this assignment, if you'd followed the TA's advice, you're going to get credit for it as long as you got to the right numbers, right? So again, back to operating, non-operating. This is the TFI. Questions about what went where? And then debt's pretty straightforward, because anything with an interest rate attached to it is debt, and then equity is equity, right? And it just goes back to the difference between accounting. Like, generally working capital is going to be current assets and current liabilities. The only difference is when we look at current assets, we're going to take out the non-operating current assets. We exclude excess cash. Accountants leave it in there. When we look at current liabilities, we exclude the interest-bearing debt. Short-term debt, long-term, current portion of long-term debt, accountants leave it in there, okay? So that's the point. Like, it's kind of like current assets liabilities. We're just netting the operating parts of that, okay? And that was what you, again, did on homework 5 when you did your assignment, okay? Now, the only thing that probably would have given you trouble here are those other categories. Like other current assets, other current liabilities. Are those operating? Are those non-operating? Hard to tell when they're called other, right? So here's the real world answer. In the real world, it depends. Meaning, you probably have to do some additional homework and either read through the footnotes, call the company's investor relations, say, hey, what's in this other current assets? All right, so we get a sense of whether or not it's recurring and going to be tied to sales, therefore operating, or it has nothing to do with sales and it's non-operating, and some of the other current assets could be both. Okay. Now, for purposes of this class, for simplification, I'm just going to basically tell you that if you don't know what it is, treat it as operating. It's basically going to grow with sales if you don't know what it is. So these other categories we're going to treat as operating unless we know otherwise. That was essentially what I had you do in homework 5. Okay. So again, if you kind of paid attention to homework 5, should have helped you as you were labeling and thinking about your answer for Costco. All right, in terms of the business and whether it was an operating or non-operating, but other current assets, other current liabilities are basically considered operating. Right. Again, questions about any of that? Does that make sense to everybody? Any questions on the TII? Operating, non-operating. Any questions on the CFI? Operating, non-operating. Or debt or equity. Anything interest-bearing, debt. And then equity is equity. All the equities are equity. So hopefully that's more straightforward. And then just the directions of the cash flows. I'm going to post the solution to this, but the solution is only going to have the numbers. It's not going to have the relative references. I'm not giving you that. All right. Now again, I'm telling you, I'm trying to make a choice. Speak now or forever hold your peace. In the last 2 classes, nobody spoke up. So I was like, did everybody get this? Everybody figure out your CFIs? Because if you did, then I don't need to give you a solution with all the formulas in it to build evaluation starting on Wednesday. You can use the models that you created. If you're completely lost and your models don't work and they don't balance, it'd be better if I probably gave you something that you could build on, because otherwise you're going to get really lost when we start forecasting all this stuff on Wednesday. Now, the last 2 classes, nobody spoke up. So I'm leaning towards just letting you use your models to build. But if somebody's having a problem, let me know.
I guess there are 2 different ways to build the CFI. There was one where it was kind of pulling things directly from the TFI and TIA statements. So
Which is the way I would want you to do it, because you have to convert the 2 to get to the 3rd.
right. It's just that I think it had less line items than the one for Walmart. Like it had less detail, that like relating to homework 5, I think.
Which one?
One of the first homeworks we did.
What I was saying, the Costco one? The Costco had less items than Walmart?
Well, you could have done the Costco one either kind of like the Walmart one, or you could have done it like the first homework we did. Which was
Yes. I would prefer that you do it like the Walmart one, because if you paid attention, the income statement and balance sheets are the same. And that's key to a reusable model. Like, we want standardized income statements, standardized balance sheets. So those standardized statements are actually coming from Bloomberg, okay, which is what part of what we're going to be talking about on Wednesday. So that I can give you any company, Tesla, and you can plug in a standardized income statement balance sheet, kind of overwrite what's there, and then everything would flow through your model and auto convert. Then it'll essentially build that tree in seconds once you copy and paste the data in. So it's actually much easier if you do it standardized. So if you tried to do it based on the original homework we did, first, it isn't tied to the Bloomberg standardized model, so that makes it more difficult. And it just becomes more challenged because then you're trying to figure out what category is which. Now, the one thing you could use the original homework on, I think you're referring to homework 4, is that it did give you some insight into what's operating, what's not operating. Like, because I had labeled that 1, 2, 3s, and 4s. And those labels would have probably helped you as you thought about what's operating and not operating. Somebody had a question in the back? Saw a hand back there.
Oh yeah, I was
Yeah.
gonna say I probably need the model use like, cause I have trouble identifying what's like operating.
Yeah, I mean, that was probably one of the toughest parts of this assignment. And as I said, the conversion was part of this, and then putting it in the format and then analyzing. But converting it is not always easy. Anybody else have trouble with that? One person? All right, for your group case, take one of your team members that you're pretty comfortable has a good model, put the Tesla data in there, that's what should be the basis for your group case next week. And then, as I said, once you put the data in for Tesla, shouldn't take long to essentially redo it, because what you're going to get for Tesla, I haven't posted yet. It's going to look like this. You're going to get income statement and balance sheet and change in equity. But as I said, if I were to look at the Tesla income statement and the Costco income statement, they're identical. Okay, so it's almost as easy as select Tesla, copy, select statement here, right click, paste special values. Right, and then if you just overwrite row for row, cell for cell, and you have references to that, everything should flow through in your model. Okay, yes?
I issue last word identify like things like I've layered each thing like ROIC tree so I can get where the sales like that is clear like what exactly that would push on with so let's figure for sales like should I just assume like CapEx would be like change in net fixed assets or something like that?
Well, again, the key here is, plugging into the tree, like what goes into operating, because the tree's only the operating items. That's why it was important to get the TFI right and the TII right, because you just want the no-plat and you just want the operating parts of the capital. But that would be the point. Once you did TFI, you have invested capital, you have working capital, and then you have goodwill. Those are the three parts of the balance sheet of the tree right there. And so they just transpose one to one, and you add them up, okay? And then same thing, on the income statement, which was the TII, like I gave you no plat, but operating income is what pre-tax ROIC is based on. If I go back to my income statement, there's your cost of revenue, so there's your gross profit divided by revenue is gross margin, so there's your gross margin. There is your operating expenses, that's your SG&A, and there's your depreciation. So those are the three items on the tree that represent the second level income statement drivers. So if you had converted and followed the format, you could literally just pull those rows right off of the tree as percentages, just make them percentages. Okay? But that was the key to this assignment, being able to do that and connect that dot. Yes, sir?
I also did some issues like sorting
So that's what I said, I'm gonna give you the Costco solution later today, I post it. Go back and look and see what I've listed as operating and non-operating to help you clarify that. Right? But again, that's part of the assignment, and I go back to, that's one of the biggest challenges in the real world. Like this is a more real world assignment to try, because you're not given, here's operating and non-operating by companies. They just give you income statements and balance sheets. It's up to us to figure it out. All right, so I'll give you those. If you have questions about why one was that, follow up with me or the TAs. But I'll at least help you with that assignment later today. So one more hand over there? No? Okay. All right, so let's go through the Costco tree and walk through this. Same idea. We have to walk through 5 years of ROIC analysis, talking about the important trends in between, using the numbers, connecting the dots along the way. So again, see if I can do this in about 5 minutes. 2018, Costco's ROIC was 20.4%. By 2022, it improved to 26.5%. That was a 30% 5-year change. Now, actually, it got to 26.5% in 2021 and then stayed flat between 21 and 22. Now, looking at the first level drivers, the first one was tax rate. 2018, Costco was paying 28.4% tax rate. By 2022, it fell to 24.6%. That is one of the reasons why Costco's ROIC improved from 20.4 to 26.5. Now, Costco also had an even lower tax rate in 2021 than 2022 at 24 versus 24.6. So it did improve even more in 21 and then fell a little back in 22. Okay, but tax rate helped ROIC. Taking out the impact of taxes, pre-tax ROIC went from 28.5 to 35.2. So the underlying business at Costco improved over the 5 years. And it also improved between 2018 and 2021, where it peaked at 34.8% before it got even better in 22 at 35.2%. Okay, part of the reason why the pre-tax ROIC went up is in 2022 is because that tax rate went to 24%. Okay? Now, looking at the drivers 2 and 3, why'd the pre-tax ROIC go up? Well, operating margin went from 3.2 to 3.4 over the 5 years between 18 and 22. That was a 20 basis point improvement in operating margin, or an 8.5% 5-year change. All of that improvement was realized by 2021, when it was also at 3.4%, but practically 3.2 to 3.4 over 5 years, it was pretty flat. Okay, so that's not the primary reason why the operating ROIC pre-tax went up. It's really productivity. Costco's a productivity story. Invested capital to sales in 2018 was 11 cents. By 2022, it fell to 9.8 cents. That's a 1.3 percentage point improvement in invested capital to sales. That was the primary reason the pre-tax ROIC improved. Right? Now, why did the invested capital sales and operating margin do what they did? Starting in second level drivers, operating margin off the income statement. In 2018, their gross margin was 14%. By 2022, it fell to 13%. They lost 1 point of gross margin over the 5 years. Okay? Most of that occurring between 21 and 22, when it fell from 13.8 to 13. You'll notice I keep talking about 21 and 22. That goes back to the context. Something happened to Costco in 21 versus 2022, right? Just like it happened to Walmart. It's related to COVID and how that affected their business. SG&A went from 9.8 to 8.7. That was a 1.1 cent improvement between 2018 and 2022 as a percentage of sales. Again, most of that occurring between 21, when they spent 9.5 cents, and 22, when they spent only 8.7 cents. And depreciation went from essentially 1 cent to 0.008 cents. Again, about a 20 basis point improvement, but basically flat depreciation over the 5 years. It stayed pretty consistent, about 1 cent per dollar per year for 5 years. So really, when we think about Costco, why did their operating margin get better? Despite the 1 point drop in gross margin, they improved their SG&A as a percentage slightly more, right? But essentially it stayed flat over the time. Again, their real driver of why invested capital to sales went better is the next third level driver, is looking at working capital, which stayed from 2.8 cents to 2.3 cents negative. Well, if they went over 5 years from negative 2.8 cents in 2018 to negative 2.3 cents by 2022, that's actually worse for them. They're spending more on working capital. So that's not why their invested capital sales improved. It's all PP&E to sales. In 2018, their PP&E to sales was 13.9%. By 2022, it fell to 12.1%. That was a 1.8 cent decline in PP&E to sales. Almost all of that occurring between 2021 and 2022, when it went from 13.5 to 12.1. Okay, so summarizing, the improvement of PP&E to sales over the 5 years from 13.9 to 12.1 was the primary reason the invested capital sales went from 11 to 10, which is the primary reason the pre-tax ROIC went from 28.5 to 35.2, and the slightly lower tax rate allowed the after-tax ROIC to go from 20.4 to 26.5. Something like that, I'll give you full credit in your presentation. Questions? Easy peasy? Repeatable? Yes?
For this presentation, are we also going to grade other groups?
Yes, you are. Okay? Because if nothing else, what I found, which I actually really appreciated, is you paid attention. Because when you gave your great explanation, you actually said things that, even if you gave them a perfect score, suggested that you listened to your teammates. And I think that that's still an important part of this. So yes, you're going to grade your other teammates. Okay. All right, CFI. Starting out with Costco CFI. Over 5 years, Costco generated approximately $14.7 billion of operating free cash flow. They generated $30.2 billion of gross cash flow for the income statement, and they reinvested $15.5 billion of gross investment in the balance sheet. That was a 51% average reinvestment rate over the 5-year period of time. Costco's reinvestment rate was pretty stable between 49% and 61% over those 5 years, and they consistently reinvested somewhere between $2.3 billion and $2.8 billion, the one exception being $4.7 billion of gross investment, which spiked in 2022. Costco's CapEx depreciation ratio is 212% over the 5 years. That suggested each year being above 100% that they were trying to grow. Okay? And even in 2022, their CapEx depreciation ratio is 155%. It's below the 5-year average, but it does suggest they still expect growth in 2023. Okay? Now, how did they turn $14.7 billion of free cash flow into $10.1 billion of CFI? Basically, how did they chew up $4.5 billion of non-operating cash flow? Well, looking at the items, they spent $3.3 billion increasing their excess cash over the 5 years, and they spent $1.8 billion increasing their non-operating assets. So those two together were the primary reason why the CFI was lower than the free cash flow. How did they distribute the $10.1 billion of CFI? $600 million went as interest expense paid to the debt holders, $119.2 million in 2022, but basically somewhere between $110 and $130 million a year in interest expense. They did increase their debt by $2.9 billion over the 5 years. The biggest increase coming in 2020 when they increased by $3.6 billion worth of new debt. They paid out $290 million of dividends to the minority shareholders, and they decreased the minority stake of their minority shareholders by $296 million. The biggest decrease coming in 2022 when they paid out $509 million to reduce their minority interest stakes. They did pay out $10.4 billion of dividends over the 5 years. The one outlier being $5.7 billion, which looks almost like a special dividend in 2021. That was also the year that Costco, the year after I should say, issued a lot of debt and then paid out a special dividend the following year, $5.7 billion. But basically $10.4 billion of dividends. They bought back $1.7 billion of common stock, approximately $200 to $400 million a year each of the years. But how did they return? 10.4 is 1.7, approximately $12 billion to their shareholders. Well, given they only had $10 billion worth of CFI, that's why they borrowed $2.9 billion worth of debt. And as we saw, they didn't really do any acquisitions. There's your Costco CFI. Questions? All right. So as I said, I can do this all day long. I do this not only in class, I do this professionally with companies. We need to practice. So I want to spend the rest of our class time here practicing. So what I've done is I put a file in Elms in the Files folder. Called LMT Example. LMT being Lockheed Martin. And the file's called Benchmarking Case 2022 dated at PowerPoint. When you open that file, you'll get this file. This is a 5-year ROIC tree, actual data for Lockheed Martin and their defense and aerospace peers. On another note, while you guys are doing your midterm exam next Wednesday, I'll be working with Lockheed Martin senior executives with this file in front of them, and we're going to go through this for real, right, with a real company. So this is very real world application of what you're doing here in this class, okay? Now, on this PowerPoint, there's 2 trees, okay? I'm only asking you to be responsible for the top tree. We're not creating the bottom trees of this class, but I'll give you a little context. When companies do acquisitions, we will do an ROIC tree with and without goodwill. So basically, in the bottom tree, we just do the exact same ROIC tree. We exclude intangibles, and we recalculate everything, okay? And you might say, why would we do something like that? And the answer is, when companies do acquisitions, the top tree is what you actually are doing for investors. Because I borrowed the money, I paid for the M&A, I got to return it, this is my actual performance. However, if I'm trying to understand the actual M&A, I want to see how the underlying businesses are doing without my purchase price premium. Like, let's say my business at Lockheed Martin, they do an acquisition, my business unit's making 20%, they do an acquisition, the next day it's making 10%, nothing changed. Like, that doesn't mean my business is worse, it just means they paid a lot more money for somebody else, okay? So, how is the actual underlying business doing regardless of their purchase price premium? organic growth, that's the bottom tree. Okay, same thing. I buy another company. I pay a premium for the company. How well are the underlying assets doing? Now I'm paying a premium. I expect that bottom ROIC tree to improve over time, but nonetheless, I still want to separate out the distortions of purchase price premium, with and without goodwill. For your purposes, for this undergraduate class, we're not going to worry about the without goodwill. We're only doing the top trees. Okay, so I want to practice just analyzing these top trees. So for purposes of today, the far row over there, you get Lockheed Martin. Analyze their tree and have a spokesperson ready in about 10 minutes to practice walking through. These two rows, you get Raytheon. Same thing. Analyze Raytheon's ROIC tree over 5 years, have a person ready to practice going through it. These two rows, you get Northrop Grumman. Same concept. Analyze Northrop Grumman's 5-year ROIC, have a spokesperson ready to present. You two rows, you get General Dynamics. And the final row over there, you get Boeing. Okay? So, spend about the next 10 minutes. It's not for grades, just for practice, but it's our last in-class practice before next Monday. So, go. Yes, sir. Okay, hold on.